All right, for months now, we've all been told this fairy tale about the economy. Well, today, that story ends.
Negative 32,000. Just let that sink in for a moment. That is not just a number. No, that's the sound of the economy finally breaking.
So, what are you looking at? This is the headline number from the ADP National Employment Report for November 2025. And it is the first negative job print of this entire post-pandemic era. It didn't just miss expectations, it absolutely shattered them. People talk about a crack in the dam. No, the dam has just been completely obliterated. And this brings us to the great fiction we've all been fed for the last year. Let's talk about this so-called soft landing. It was never real. It was a complete narrative, a piece of gaslighting designed to do one thing: keep the market complacent while the real economy was rotting from the inside out. I mean, just look at the sheer scale of this disconnect. The so-called experts, right? They expected a gain of 110,000 jobs. What do we get? A loss of 32,000. That's 142,000 jobs swing to the downside. This isn't some minor forecasting error. No, this is willful, head-in-the-sand ignorance. So let's be absolutely clear. This soft landing narrative, it's officially dead. Buried. That whole story about a resilient labor market propping everything up is over. The foundation itself, the job market, has just given way. The hard landing isn't coming. It has begun.
Now, here's the really bad part. This isn't just a simple recession, the kind where the Federal Reserve can just ride in on a white horse and save the day. Oh no, this time is different. This time they are completely and utterly trapped.
And the reason why is a word that should send a chill down your spine: stagflation. It's the boogeyman of central bankers for a very good reason. It means the economy is shrinking, and we now have definitive proof of that with these job losses, but at the same time, prices are still rising way too fast. It is the absolute worst of both worlds. I mean, think back to the 1970s. That's the playbook we're seeing right now. Real economic pain coupled with prices that just refuse to come down. And that's the rub, right there. Even as the economy is clearly sinking, core inflation is still stubbornly above 3%. It's sticky, it's persistent, and it has the Fed locked in a straitjacket. So you're probably thinking, okay, what's the big deal? Why can't the Fed just cut interest rates to save the economy? I mean, if jobs are being lost, you just stimulate things, right? Wrong, and that is the trap. Look, this is the Fed's impossible choice. It's checkmate. If they cut rates to try and save jobs, that sticky inflation is going to roar right back to life and absolutely crush consumers. But if they hold rates high to keep fighting inflation, they just accelerate the job losses and drive us into an even deeper recession. Do you see? There is no escape hatch. They have no good options. And believe it or not, it gets worse. These job losses, they're not the end of the story. They're just the beginning. They're the trigger for the entire next phase of this crisis. See, this was already happening, just bubbling right under the surface. Take a look at this chart. Delinquencies on auto loans, they've been spiking for months. Credit cards, same story. People were already struggling to pay their bills when they had a job. So let me ask you, what do you think happens now that the paychecks stop coming? This is it. This is the moment. That negative job print is the final domino. It takes this worrying trend of people falling behind on their bills and turns it into a systemic, full-blown credit crisis. All the fuel has been piling up for months, and this jobs report, it just lit the match. And look at how fast this is going to happen. The timeline here is terrifyingly short. The labor market just cracked this month. Next month, you're going to see an absolutely disastrous holiday spending season as fear really starts to set in. And by the first quarter of next year, we will be right in the middle of a widespread credit event. Defaults are going to cascade through the system. So let's bring this all together. What does all of this, the shattered narrative, this stagflation trap, the looming credit crisis, what does it actually mean for the stock market? Well, it means the music has stopped. The party is over. And anyone who's still on the dance floor is about to face a very, very brutal hangover. This is your economic reality check. Right now, the S&P 500 is trading at a forward PE ratio of 22. Okay, what does that mean? It means investors are paying 22 times what they hope companies will earn next year. In an environment of zero growth, rising defaults, and a shrinking economy, that's not just optimistic, it's completely ridiculous. It's an unjustifiable valuation. The prices you're seeing on your screen right now, they're built on a complete fantasy. They're based on the assumption that corporate profits are just going to keep growing and growing as if nothing is wrong. But we now know that's a lie. That growth has vanished. It's gone. So what does a return to reality even look like? It looks like a significant correction, a drop of 20 to 30%. Listen, that is not fear-mongering. That's just the simple math required to align market prices with this new, harsh economic reality. This isn't about panic. It's about repricing risk. The market has been operating on this fantasy of a perfect outcome. Well, we now have confirmation that the outcome is going to be far, far from perfect. Look, the playbook from here is not complicated. It's simple. First, you raise cash. Second, you get out of those high-flying, no-profit speculative tech stocks that have been flying high on hope. And third, you avoid any company that is loaded with debt because they are going to get crushed when the credit markets freeze up. Defense, that's the only strategy that matters now. So let me be crystal clear about this. We've laid out all the facts. We have the data. The hard landing is no longer a forecast. It is here. At this point, if you are still fully invested in this market, you are not investing. You are gambling. You are sitting at a casino table where you know the deck is stacked against you. The choice, as always, is yours.